Let me introduce our panelists. Right, we had Philipp Sebbesse from DC Advisory, Sven Oleownik, partner at EMERAM Partners. We have Todd Albright from Datasite, and last not least, right, we have Michael Carr from Aon. Thank you so much. Thanks for being with us. Gentlemen, we had a nice outlook. How do you feel?
No, it's an easy one now, yeah.
So, Philipp, what do you see? I mean, maybe starting with a bit, obviously diving into the keynotes, right? And looking. I mean, always see I think we very much, live and work in this microsphere, and don't always have the the big macro view. And just until recently, we always was still thinking in these Chinese categories, expanding, making use of the market, looking at the numbers of targets and companies. I mean, from an M&A advisory side, do you see a shift already de facto in terms of what is interested? How do you value Chinese pieces of companies, for instance, which come up for sale? And
yeah, I mean, absolutely. I mean, looking at the, let's say, investment area, clearly what you have seen over the last couple of months, even more or less years now, is that the China interest in assets, in particular now, let's say, German-speaking markets or Germany in particular, is shrinking, or is going down substantially. And that is not only due to the geopolitical aspect and certainly also FDI and all these, let's say, complexities which typically an investment into Germany would trigger for those investors, but it's also simply that they are not interested any longer, because I mean they have now gathered quite some technology for their internal, let's say, economy. So therefore, there's not the need for further investments. And what we also see, and that is not only related to China. I mean, when also talking to Japanese, I mean, I'm with a Japanese bank, yeah. So therefore, when I'm talking to Japanese investors or larger corporates, they also tend to shy away from, in particular, Germany. They say, okay, look, I mean, Europe. We can still consider, but I mean Germany currently, I mean there's no interest really, and that is not related to certainly geopolitical aspects. That is clearly because of, let's say, our issues we have here at hand these days. Yeah.
And so the world is changing.
Yeah, sure, I guess.
Sven, as an investor, do you have a look at sort of the Chinese impact? I mean, has there been a shift basically? Do you think, talking about private equity perspectives, or how is it realizing, as regards Chinese markets, what's the view of private equity?
Well, I would say there are different levels of looking at. For example, if you're talking to our LPs, basically, even coming from the US, they basically say, well, of course, for us, the US is interesting, but on the other hand, geopolitical and political tensions amongst China and, for example, Taiwan, of course, and even our country are increasing. India is complex, Africa is difficult, and South America hasn't delivered, so Europe remains very attractive. So this is a complete counterposition to what you are saying. On the other hand, of course, the markets are developing much more even there, so it's not that easy to just export something which has not too much value to these countries. So you have to rethink your complete strategy when it comes to revenues, and you have to rethink your strategy when it comes to supply, because I guess since the vessel got stuck in the Suez Channel, it's pretty clear that our supply chains are very fragile, and you have to think how to make it more stable. So it's indeed, and I would say from different aspects, a complete change in strategy.
Todd, can you also confirm that from looking at what you see, at Datasite, basically in terms of what sort of transactions are going on, what the focus is? I think you have access to a lot of data on a generic level in order to see what's going on in the markets.
Yeah, Nick, I'd say that, so Datasite, for those who don't know, we provide services to the mergers and acquisitions community to facilitate deals, basically the sharing of content. We support about 15,000 M&A and related transactions, fundraisers, et cetera. And specifically what we're seeing is and particularly the business we support in Asia, it's mostly cross-border M&A. And there you've seen within our statistics a pretty distinct drawback in terms of, I mean, the professor talked about it, but foreign direct investment in China. And I would echo what Sven said is, whenever you have disruption, you have opportunity, right? A lot of talk about where does India sit in all of this, and just staying on the Apple theme, the most recent iPhone was manufactured in India. It wasn't manufactured through Foxconn in China. And so, like for all of us that are seeking opportunity, and what we're seeing in the data at scale is to say that you're seeing a lot more cross-border M&A within South America, in the Americas, if you will, hemisphere, and then, similarly in Africa from Europe.
Interesting. Yeah, and again, as you say, opportunities out there, right? I mean, I'm curious to see how that evolves over time, looking at, the BRICS states, maybe taking aside China for a moment, but the Southern Hemisphere, as Sebastian has pointed out, there will be certainly lots of opportunities in that.
Yeah, and just to build on that, I was recently in Japan, and the economy in Japan has been in slow growth mode for a long time, and you have an aging, just moving off China a little bit, you have slow growth that's happening, and so what you have is a bunch of outbound M&A by Chinese corporations to acquire assets in markets that are growing, and so you have a lot of outbound buy-side M&A activity from Japan into Southeast Asia very, very specifically. And so again, whatever your circumstance is, whether you have an integrated supply chain in your Volkswagen, right, Christian, and you're building a bunch of automobiles in China, at some point that's not going to be, and it's going to take a decade to transform, but you're going to have to find other partners somewhere, and that's going to drive financing requirements, capital markets activity, and obviously mergers and acquisitions in those markets.
All right. Michael, I mean, taking, also, obviously, Aon has a very clear view on risks and a steady assessment going on. How does these geopolitical shifts play into that?
Great question and a fantastic keynote speak, right? So, decoupling as a theme is huge, and it's much broader than just what we saw around kind of China, etc. We've obviously seen a kind of a decoupling from kind of Russian gas. And that's kind of part of a overall decoupling from carbon, and also a decoupling from a quite benign monetary policy environment. So there's been a lot of decoupling themes going on over the past kind of 6, 12, 18 months. And where we're seeing that is providing kind of multifaceted challenges. Like, we were speaking to an infrastructure fund recently. How do we attract financing to build a wind farm off the coast of Taiwan was one of the most interesting questions we've had over the past 12 months or so. And then, the impact of kind of financing costs, and what that does is, as they go up, your ability and your desire to retain risk starts decreasing. And so you start to look at what are ways you can de-risk your supply chain. How do you either de-risk or transfer some of your tax contingent or credit risks to ensure that you can start to give your investors a lower level of volatility than the macroeconomic environment, whether that be monetary policy or geopolitics, tends to indicate you should be facing. So there is alternative forms of capital out there to help decrease that volatility.
Okay, so let's look at that maybe and dive into our day-to-day business, at the opportunities and what's going on. So, with current market, what is the deal flow like? Let's start with that. What do you see, Philipp?
Overall, I guess it's soft. It depends certainly also a bit on the industry you're looking at, right? Like healthcare, software, that's always, could certainly also, when carbon footprint, decarbonization and all that stuff, that certainly tick the boxes there. But when it comes to other industries, like in particular industrials, for instance, here in Germany plays quite an important role typically. We see less traction there, yeah? That is typically, related, or let's say caused by all the macroeconomical implications, be it supply chain, we had that, also geopolitical aspects clearly, then everything which is related to inflation, energy costs and so forth, so that clearly, presses the profitability, and therefore it's not the best time probably to sell these assets. Plus, and that is also clearly a factor that private equity these days, not only related to the high interest rate environment, is clearly not the best buyer for those assets, or does not really like those. Yeah. So therefore, I think that overall deal activity volume went down substantially.
Sven, is that what you would also echo? And you know, private equity, as you always have the talk about lots of dry powder, i.e. lots of opportunities maybe due to the, you know, the prices might tend to go down due to the interest rates. Do Mittelstand sellers want to sell, you know, because there are too many crises, one after the other, where they say there's no end to come. So before I end, I rather, you know, have an exit, whatever it might be, not as good as a few years ago. What do you see in the market, and how does EMERAM approach these circumstances?
So in principle, I would agree that the industrial sectors, of course, is a bit harsher, and of course, a lot of industries which are driven by energy costs. They are kind of, let's say, investors are quite hesitant around it. Yeah. And we are, by the way, not investing into industrials unless there's no service or specific tech angle. So we would consider. So if we would look at our relevant deal flow, it's a bit less indeed than the last years, but it's still very attractive. We are investing only in growth opportunities, so there are still a lot of opportunities around out there. And not only because if there's a crisis, there are a lot of opportunities, but even indeed because there have been a lot of crises, and some of these Mittelstand companies, of course, they are kind of fearing that they are completely invested into their company. They basically say, oh, we are completely maxed out, and we want to diversify somehow our wealth, even to feel my family a bit better. To make my family feel better, and therefore they are looking for partners to invest into these opportunities, to have more funds available, to indeed acquire some other companies, to go to other markets, because when competition is weak, it's even sometimes a bit easier to gain market shares, and of course that's not an easy one, but however, it's not that easy to find the right deals and to find the right strategy. You need to think about more where we want to go with the company, what will the company do, how will it look like in 5 years from now. And so the discussions have been more intense, more detailed, and take even longer. But however, there are great opportunities still out there.
Todd, is that something, what do you see in terms of the data?
Yeah,
I mean,
2021 was nuts, right? It was like, how awesome was it to be in M&A, and you know, money was free, and gosh, we had all that largesse coming off of the pandemic, and you know, at least in my country, the United States, we had 2 successive presidential administrations trying to figure out how to print even more money than the previous, okay? And so then along comes this war, right, last year in Ukraine, and that was an existential moment for many of us, and it started this decoupling, which was already happening with the energy markets, but it also brought a great degree of uncertainty, and now all of a sudden, inflation wasn't a theory, it was actually happening. And so what we've seen in the data is that you kind of like the needle on the record, if you will, it all kind of stopped in June of last year, and we were in the doldrums of the water, and you couldn't really get a sense of direction. However, what we've seen to begin this year is a lot more activity on our platform, and the activity metrics we look at is the number of new projects or new transactions that are launching. We look at the amount of content being accessed in those transactions, and then just utilization statistics. How many people are logging in every day to do something? And typically it's the more junior members of the deal team or the legal team that are actually in there interrogating. And as of last quarter, we were seeing all-time records for engagement on all 3 of those metrics, so that's bullish. That said, I would say in the last few weeks, uncertainty has started to return again, the presentation notwithstanding, right? Because that's a longer arc, but we're kind of at a crossroads of what is inflation really going to do, right? It was debatable what the ECB was going to do in terms of rates, and in the US on Wednesday we'll probably announce that we're holding, but inflation still isn't licked yet. And so what we're seeing in the data actually is a bit of softening, and that's a global view. The next big shoe to drop obviously will be financing. So right now, a lot of portfolio companies, and that's what we saw in the private equity community, Sven, is a lot of our private equity partners were spending time stabilizing the portfolio companies that they had, and then creating continuation funds beyond that, because here we have good assets, but the market just isn't ripe for some sort of harvesting. So our expectation is you're going to see, once inflation over the next couple of months has a fixed point, if you will, a terminal rate, you're then going to have a huge wave of refinancing walls that are going to be hitting, and that'll spur another round of activity because well-capitalized German Mittelstand companies in many cases will be in a position to buy and acquire those that aren't as on strong financial footing. Again, that's what our data is showing.
If I may add shortly, please.
Sure.
First of all, I would partly disagree because setting up continuation funds doesn't necessarily mean that you are struggling with your companies and then you have to somehow re-stabilize them and then bring them to the market, because at the moment there's an opportunity, because we have been doing 2 continuation vehicles, and the simple reasons that we are believing in these companies. They are still growing and there are lots of opportunities, and we want to secure the same governance. And sometimes fund cycles are not fitting to strategic cycles of the company, and therefore just profiting from further opportunities could drive also in this direction. Of course, it's right that sometimes you need to stabilize, but not always. The second point, which we see strategically, is probably that in the past, of course, we always had some cycles in our economy. But I personally believe that we now have really severe structural changes, and this is somehow different, because in the past, at least from a German perspective, we had a very good labor force, we had a fantastic education, but now also Chinese have a fantastic education. And here we are lacking working force. We have a migration issue, we have political issues, we have the climate change, we have, I don't believe in these topics about Generation Z and stuff like that, because we see a lot of young motivated people. However, of course, future is not the bright and the blue sky any longer. So, and this is different, and this is where we need to find solutions for. And I think here even private equity has a specific role in supporting and fueling this kind of change, and opening up new perspectives even.
Absolutely, absolutely. So. And that will impact deal flow. I mean, is the opportunity to generate deal flow
and the role, deal flow and the role, deal flow, return, and the role of how to work together as shareholders and indeed
shaping
partnering
society and bringing it forward.
And partnering with different stakeholders, of course.
Michael, as regards to from Aon's perspective, obviously you also see a lot of developments in terms of sectors, in terms of gravitude and so on. What's your view on recent developments?
Yeah, I'd concur with the rest of the panel. I mean, the picture in the rear view mirror is pretty ugly, right? I mean, the cost of financing has doubled, the amount of it has decreased, some of the kind of leverage levels have contracted, and this contributed to a pretty tough rear view mirror. And if we look out through the windscreen, then there is a huge amount of uncertainty, and there's going to be some significant kind of transitions and need for reform. Sven, you touched upon some potential labour market reforms. You've got here in Germany, if you look at the kind of the green transition, you've got most of your potential energy supply in the north and most of your potential energy demand in the south, and there's going to be some quite big infrastructure questions around that. And going back to the financing point, what we're starting to see is people looking through the windscreen, seeing that uncertainty, and while some of the drivers like inflation seem to be flattening out, people understand that higher for longer is likely to be true. And so a number of clients and deal makers are coming to us saying, in the relatively unexplored areas of our balance sheets, what assets do we have that can help unlock or support financing? So to what extent can we look at our intellectual property or our intangibles and unlock potential financing through that in a way that makes the banks or the private credit lenders more comfortable? To what extent can we look at our working capital optimization and use some of the collateralization capabilities of the insurance market to help increase the liquidity that we're facing? So I think, look, the rear view mirror definitely looks worse than the windscreen, but the uncertainty can go one or two ways, and there's no doubt there's a huge amount of challenges there. If I look particularly at the German region, there are still huge amounts of assets in terms of brands, technology, etc., that give us significant cause for optimism. And it's not like this particular economy hasn't faced substantial historical challenges, right? And if you look at the the reunification and how the productivity miracle that Germany has delivered over the various kind of economic cycles. There is, I think, as many reasons to be optimistic going forward as there are to be fearful. But nonetheless, there is that reform and transition process. There will definitely be winners and losers through that.
I mean, you mentioned sort of the obviously the interest rates and how players try to react and by means of new structures of finding assets to collateralize, etc. The higher interest rates, how do they impact sort of the strategy on existing portfolios? I mean, to start with, Todd, do you see, is there, has the number of private equity activity on the sell side decreased because simply, the investment thesis, don't match with current interest rate environment maybe, and one waits until, things change? Do you see a decrease there, or what's your view, or does it depend on sector again, et cetera, et cetera?
I mean, we're
looking at the players sort of and looking at private equity. How does it cope with, as regards its status portfolio companies?
I mean, I think Sven said it. If you're a private equity firm, you bought an asset because you believe in the asset. And funnily enough, economic and financing cycles could give a damn about our respective J-curves. And so what you have is you have a doubling down and to retain those good assets for longer. That's simply the case. What we're seeing in some of our private equity companies is as those realization events get pushed out, the business model is slightly disrupted because your success fees, your operating costs are continuing, and your financing costs may be going up, but the amount of liquidity that's coming into the system is somewhat stymied just because of market. And so the activity we're seeing is opportunistic buying by the portcos within the funds because there are winners and losers, and so there's a roll-up opportunity there. You're seeing continuation vehicles forming in order to retain good assets that you have and create those opportunities. But again, many of the transactions or many of those were financed under terms that existed 2 or 3 years ago, and so the next trick is going to be the refinancing. That's what we're seeing in our data.
All right, Philipp.
Yeah, I guess, I mean, I don't have the data now here like Todd has, but I mean, my impression is that clearly, I mean, private equity on the sell side is not a typical phenomenon we currently see. Yeah? I mean, for obvious reasons. I mean, clearly, I mean, the probably returns would be somewhat not that great as they had before. So therefore, currently, I don't see too many private equities selling good assets. Yeah? Having said that, clearly there is always, I mean, ideas around, let's say, value creation, what you were mentioning, and I think that will become even more important going forward, and with various aspects. And you said that talking more or less to every stakeholder, all the stakeholders around the assets, it's about decarbonization and so forth. Historically, I mean, clearly a lot of the returns of private equities also was due to the fact that we had multiple arbitration in a way. I mean, markets went up and money was cheap, etc. Now we have a certain period of higher interest rates, and now it becomes even more important to let's say work with the assets and the investments and create value per se. And I think quite an important pillar will be decarbonization, because there is no blueprint yet. And the private equity has an advantage vis-a-vis some others that they have typically a majority in the business and they can work with the assets longer. They can start day one and they can deploy also investments even during their holding period. So therefore, I think that is they are best prepared to really capture that. And then we have these, let's say, sustainability arbitration possible, so that you really realize return due to the fact that you bring your assets forward also in terms of those aspects like decarbonization, but also value creation, clearly.
And Todd mentioned sort of the opportunities, Sven, in terms of roll-ups, effectively buy and build strategies, and I think you have a specific focus as well, sort of in terms of value creation on buy and build strategies. Do you see lots of opportunities in that field?
So first of all, I would agree with Philipp, and the good news is that investing in private equity is much older than zero interest rate policies of central banks. Yeah?
That's right.
And however, times are a bit more challenging. And if we look at our recent buy and build strategy, for example, of course, there's a market which is growing. It's basically a market which is not yet consolidated, so we can tick a lot of boxes. And if we and there are a lot of advantages in making the company much bigger, because then you can organize how to work differently, you can educate your own people, recruiting is different, so you can solve a lot of critical aspects. And what you can also solve is that a lot of these, let's say, smaller companies cannot be sold at the moment, or at least not be sold at a price which is in the head of the current shareholders. So you can offer them, in a way, a structure. You can offer them a structure where they can basically sell a part of their companies, reinvest it in a larger structure, and then also take their fair share of the larger company, of all these synergies, let's call it like that. And this makes it very attractive, because then you have, and this is what we see at least in our opportunities, we have lots of opportunities, and we have more prioritization issue than rather a deal flow issue when it comes to buy and build, to be honest. And then, of course, an integration issue as well, because it's not that you buy something and add 1 + 1 is then 2, but well, it's a very it's platitude. How do you say in English? Anyway, but integration is an issue, of course. If you want to, because it's not that easy to make something just twice as big. It's even about making it X times better. And here is when, let's say, the crucial point kicks in.
And talking about sort of, supporting, building new, new structures and helping build in terms of society with all the players and stakeholders. Maybe talking a bit about, you mentioned it, Philipp, the change of the industry structure de facto, right? I mean, and talking about decarbonization, Energiewende, and so on and so forth. In terms of what do we see happening then, investment flows, the interest. Michael, do you have a view on what's happening in that area? I know that Ian also, in terms of, again, looking at risk, looking at opportunities. How do you look at sort of the new world of, it's not only energy driven obviously, but it's more the combination of ESG aspects or the environmental aspects, decarbonization,
yep,
energy and infrastructure.
So, I mean, the retirement and kind of wealth part of Aon, we have about $3.8 trillion of assets under advisement, right? And if you speak to kind of the LPs and the investment advisors in that part of the business, then, I mean, there are two things that are kind of very, very prominent at the moment. One is going back to your conversation about kind of the exit environment, right? The exit environment in the first 6 months of this year was down by about half, right? So there is a kind of a significant need to create, for sponsors in particular, to create liquidity events, right? And, Sven, you touched upon some of the kind of seller financing minority stakes tactics that are being used to do it, because otherwise the ratios get out of whack, right? They've got too much allocated to this particular asset class. Having said that, the overall appetite for the asset class still seems kind of strong and resilient, and kind of the word resilient is quite a nice segue in terms of, if you look at the balanced scorecard of how LPs are evaluating funds and kind of particularly private equity, then the increase of the sustainability and the resilience and the fact that you are bringing multiple stakeholders along with you is becoming more and more a critical success factor to actually accessing the capital, right? And that's both at how you're governing kind of the fund, but also how you're looking at the potential investments and how you're contributing to the wider kind of ESG and sustainability goals. So yes, it's challenged because if we don't create liquidity events, then it's pretty difficult for people to carry on piling in, right? And some of the criteria for accessing the funds that are still very much available have changed and strengthened, as you would expect, right? Because with a macro environment that is less conducive or less helpful, then investors need to know that the governance structures and the strategies, etc., all stand up to scrutiny to a higher level they do when the macro environment's a bit more helpful.
Thank you so much. Thank you so much. Maybe for the end, in 2 sentences, looking forward the next 12 months until the next pemacom, what do you expect markets and the environment to be like?
Brilliant.
Were you on
We
the
wanted to have a short. I mean,
Were you on the Oktoberfest yesterday? Brilliant. Yeah, that's what I want to hear. Brilliant. Sven.
I think challenging, but still very attractive. So looking forward to a next year's session to prove what I said.
We'll test that. Yeah. Todd.
We're investing in growth. We're hiring more staff to handle the volume. There's an expectation, an opportunistic expectation.
That's great. Michael.
I mean, I'm not going to change the overwhelming level of optimism. Right?
Change the script now, yeah?
And look, I mean, Philipp has kept consistent with 100% of other advisors I've spoken to over the last kind of 12 months. The next couple of quarters are going to be great, right? But look, I think we've definitely seen the best assets have carried on moving. I mean, the rest are still there, and like I say, there are a couple of examples we've had over the past quarter where we've seen, for the first time, deals that fell down even in kind of almost nicer environments in 21, where they're coming back to market and people can start to figure out how to make the returns, and some of those expectations are adjusting. So actually, I think there's grounds for the optimism.
Fantastic. Well, thanks to all of you. Thanks for the opening panel. And we have a short coffee break until we continue according to the agenda. Thank you.
Thank you.